Crypto lending explained. Earn interest like a bank. Earning money with crypto doesn't have to mean chasing volatile prices or making risky trades. In fact, one of the most underrated ways people earn with crypto is by lending it out and getting paid interest in return. It's a concept as old as banking itself, now powered by blockchain technology. In this video, we'll break down what crypto lending is, how it works, where you can do it, and most importantly, how to do it safely. Whether you're new to crypto or just looking for low-effort ways to grow your portfolio, this guide will help you understand how to start earning interest just like a bank would. Before we dive in, here's the legal side of things. Crypto assets are high risk and not regulated in the UK. You could lose all the money you invest. There is no consumer protection. This content is not financial advice. Always do your own research. Let's begin with the core idea. Crypto lending means you deposit your crypto into a platform or protocol where other users, often borrowers or traders, can access it. In exchange, you earn interest based on demand. You don't need to be a tech genius or developer to start, just a basic understanding and a few minutes to set it up. Think of it this way, you're acting like a digital bank. Instead of your money sitting idle in a wallet, it gets loaned out to others who need liquidity. You earn interest, and the borrower pays it, just like a traditional loan setup. Crypto lending generally falls into two categories, centralized lending and decentralized lending. Each has different trade-offs in terms of control, security, and ease of use. Let's start with centralized crypto lending. These are platforms run by companies like Nexo, Binance, Coinbase, and previously Celsius. You create an account, deposit your crypto, and start earning interest right away. It's simple, often beginner-friendly, and usually comes with customer support. The biggest appeal of centralized lending is ease of use. You don't need to set up a separate wallet or understand blockchain mechanics. You just sign up, verify your ID, and deposit funds. Some platforms offer flexible terms, meaning you can withdraw anytime, while others offer fixed rates if you lock in your coins for a set period. Returns vary, but stablecoins like USDC and USDT often offer between 4% to 10% annually, depending on market demand. Coins like BTC or Aave may offer lower yields but still generate passive income over time. However, the major risk with centralized lending is custody. When you deposit to a centralized platform, you're handing over control of your assets. If that platform gets hacked, mismanages funds, or collapses, you could lose your crypto. This is exactly what happened to Celsius and BlockFi, platforms that promised high returns but went bankrupt during market crashes. That's why research is critical. Always check platform transparency, regulation, user reviews, and whether they offer insurance or reserves backing. Trust is everything in centralized lending. Now let's talk about decentralized lending, also known as DeFi lending. This takes place on open blockchain protocols like Aave, Compound, and Venus. There's no company in the middle, just smart contracts that handle everything transparently and automatically. With DeFi lending, you use a Web3 wallet like MetaMask or Trust Wallet. You connect it to the platform, deposit your crypto into a lending pool, and immediately begin earning interest. Other users can borrow from that pool by providing collateral, usually over-collateralized to protect lenders. For example, if someone wants to borrow $1,000 worth of crypto, they may need to deposit $1,500 worth of collateral. This protects the protocol, and you, from losing money if the market turns against the borrower. Interest rates in DeFi vary constantly, based on supply and demand. Stablecoins like DAI or USDC often offer 3 to 7% yields. Some platforms even reward you with additional tokens as an incentive. This is called liquidity mining, and it can boost your returns significantly. So what's the catch with DeFi? Well, first, it's more technical. You're responsible for using the correct network, managing your wallet, and paying gas fees. If you make a mistake, like sending funds to the wrong contract, there's no customer support to help you. Second, DeFi carries smart contract risk. If there's a bug in the code, hackers can exploit it. That's why it's crucial to stick with well-audited platforms that have a track record of safety. Aave and Compound, for example, have billions in assets and years of successful operation behind them. Let's compare the two models. With centralized lending, you get a smooth user experience, fixed returns, and customer support, but you give up control. Your funds sit in someone else's custody, and you rely on the platform's integrity. With decentralized lending, you stay in control. Your funds remain in your own wallet, and everything is run by code. It's more transparent, potentially higher yielding, and censorship resistant, but it requires more understanding and carries risks tied to code bugs or network congestion. Both methods have their place, depending on your goals. If you're brand new to crypto and just want to test the waters, centralized lending might be the easier entry point. If you're comfortable with wallets and want to avoid middlemen, DeFi gives you full control. Now let's talk about how to start lending. For centralized platforms, it's usually just a few steps: create an account, pass KYC verification, deposit your crypto, and choose a lending option. Binance Earn, for example, has flexible and locked products depending on how long you want to commit your funds. For DeFi lending, you'll need a Web3 wallet. Once set up, you visit a protocol like Aave, connect your wallet, and deposit tokens into the lending pool. Rewards begin accumulating automatically, and you can monitor your interest in real time. Some users prefer lending stablecoins like USDC, DAI, or BUSD because they don't fluctuate in value. This offers a more predictable return, similar to a savings account, but without the price risk of assets like Bitcoin or Ethereum. Others enjoy lending altcoins or even participating in new DeFi protocols that offer high APYs. These can deliver higher returns, but also carry more volatility and risk. The choice depends on your risk tolerance. Let's now look at some of the key risks you should always consider. First, there's counterparty risk, especially in centralized platforms. If the company fails or mishandles funds, you could lose everything. This is why, not your keys, not your coins, is more than just a saying. Second, there's smart contract risk in DeFi. Even with audits, vulnerabilities can be exploited. Never invest more than you're willing to lose, and stick to trusted protocols. Third, consider market risk. If you're lending a token that drops in value while it's locked up, your interest might not cover your losses. This is why many prefer to lend stablecoins. They eliminate the volatility factor. Also, look out for platform fees and withdrawal limits. Some centralized platforms impose limits on how quickly you can withdraw, or apply fees that eat into your profits. Always read the terms before committing your funds. So what are realistic expectations? Most users earn between 3% and 10% annually from lending, more with rewards, less with highly stable options. These yields are far higher than traditional bank accounts, but they come with crypto's inherent risks and responsibilities. Still, for people who want to earn passively without trading or timing the market, crypto lending can be a strong addition to their strategy. It's about putting your assets to work instead of letting them sit idle. And over time, if you reinvest your interest, those earnings can compound, boosting your returns without requiring any extra effort. That's the beauty of passive yield in Web3. To get started, decide if you want to go centralized or decentralized. Research the platform. Choose stablecoins for lower risk or tokens you already believe in. Start small, monitor your rewards, and learn as you go. Crypto lending isn't a get-rich-quick scheme, but it is a consistent, transparent, and scalable way to grow your portfolio. And as the ecosystem matures, it's only becoming safer and more accessible. If you found this video helpful, check out our playlist on passive income strategies next. We've got full guides on staking, real yield farming, airdrops, and more, all designed to help you earn with confidence. And don't forget to like, subscribe, and drop your questions in the comments. This is Crypto Pulse, where deep dives meet real insights.